In this second and final part of this spreadsheet modeling, I show the construction of the efficient set. To do this, we're going to need to estimate two parameters, the variance and the mean of the portfolio. So I have shown here the definition of the variance of a three-asset portfolio. 1, 2, and 3 for Argentina, Brazil, and the US stock indices. And I've also shown the mean of the population of the three-asset portfolio. So here's the final result right here. All right, so what I'm going to do, because the calculation of the variance of the portfolio is quite extensive, I'm going to stay out here and calculate it out so you can see how I dealt with it right here, because if I click here you will see the long formula right there. So now, but keep in mind that the variance, or if you like, standard deviation of a portfolio is a function of three variables. One is going to be the individual security variances. We already have those estimated right here. All right. Two is the covariances of the pairs of securities in that portfolio. Now we have that here in this variance covariance matrix. They are going to be the off-diagonal elements. And thirdly would be our choice variable, the proportional amounts we wish to invest in each of the securities. So that's the choice you have to make. You don't calculate it, you simply identify it. For example, if I scroll down here, right here, we find that we have chosen to invest 20% of our money into the Argentine portfolio, 60% into the Brazilian portfolio, and 20% into the American portfolio. Keep in mind that the sum of your weights must equal 1. So right here on this margin, if I scroll up, you'll see where I wrote total weight, and you would see right here that these are calculated. If I hit F2, you can see it right here. So it serves as my check to make sure that the sum of the weights is equal to 1. All right, and all you have to do is to simply come out here in the first hand and hit equal SUM to sum it all up, and highlight these three cells, close parenthesis, and hit enter, and then you copy it down. That way, as you put in the weights right here, you're going to see the check. If it's less than 1, then you adjust the weights. If it's more than 1, you adjust the weights, etc. The second thing is, if you observe, I have also allowed for short sale. For example, let's look at this one right here. Let's take a look at this right here. So this is a case where, say you have $100, you invest $80 into the Brazilian portfolio, meaning 80% of your money. So you see that leaves you with 20%. Now though, but you went ahead and borrowed 20% of your money, of your $100 equity, against the Argentine portfolio, meaning you borrowed $20 against the stock, aka you short sold the stock to the tune of $20. So now, coupled with the 20 you have remaining, you invest the entire $40 into the US stock market. So as you can see, you have a 40% long position in the US stock market, 80% long position in the Argentinian stock market, in the Brazilian stock market, and you short sold 20% of your equity in the Argentinian stock market. So you can see that there are more aggressive short selling out here against the Argentinian stock market, and going down, I also did some short selling in some cases in the Brazilian stock market as well as in the US stock market. Either way, whether you choose to allow short sale or not, make sure that the sum of your weights equal 1. It is a choice for you to make. You don't have to allow for short selling. Whatever you like, any weights that you put here work, insofar as, again, the sum to 1. So let's go ahead with the calculation. So I'm going to go back up here and begin the calculation for variance, and I'm going to be looking at this formula. I hit equal, open parenthesis, it says W1 squared. This is the first weight here, and I square it. hat 2 is to square, multiplied by sigma 1 squared, which is the variance of the Argentine portfolio. So I'm going to go up here and just click right here, the variance right there. Now be careful if I scroll down right here. Now you see the formula says sigma 1 squared. Keep in mind that sigma squared is variance. So this is already variance. You don't have to square it twice. So just simply close parenthesis and add the next plus W2 squared, and this is W2 hat 2 would square it and then multiply that by the variance of Brazil, and I go up here and I click on variance of Brazil, and again I have to be careful not to square it. If you want to square, if you feel like squaring, then click on the standard deviation and then put hat 2, because that'll get you back to variance. Alright, so with that, not squaring my variance, I simply close the parenthesis plus open parenthesis, and now I'm going to get my W3 right here, and then hat 2 to square it, multiplied by the variance of the US index. So go up here and click this guy right there, and then scroll down. You don't have to scroll down to close parenthesis, but I'm doing that so you can see my work. So as you can see, I'm done with the variance arguments, the first 3 terms. Now I'm going to go to the 4th term, which will get us into the covariance territory. So plus, I open parenthesis, 2, which this constant right here, multiplied by W1, this is my W1, multiplied by W2, this is my W2, which is Argentina and Brazil. Alright, and then multiplied by the covariance of Argentina and Brazil. So I go up here into the covariance metrics. This is Argentina and Brazil's covariance right there. So as you see right here, I close parenthesis plus open parenthesis. Now again I'm going to go and now I'm into the 5th term right here. So it would be 2 multiplied by W1, which is Argentina, multiplied by W3, which is the weight for the US stock portfolio, multiplied by their covariance of 1 and 3. So if I scroll up, that's it right here. 1 and 3 is Argentina, and the 3rd portfolio, which is US. So that's it right here. I close parenthesis, and then I add the final term. The final term is this right here. Open parenthesis, as I've just done, 2 multiplied by, I scroll down a little bit so I can see my weights. It's going to be the weight for 2 multiplied by the weight for 3. This is the weight for 2, which is our Brazil, multiplied by the weight for 3, which is US right there. Right? Now you can see why I came back up here to make this calculation, because I know it's going to run over. But anyways, you can see what I'm doing there. And then finally, I multiply this by the covariance of Brazil and the US. So for that, I go up here and I catch it right there. Alright, it registers there. So I close parenthesis and hit enter. Now as you can see, this is what I have right here. So, and as you can see, it would have been squeezed up if I did it right here. So anyhow, so this is how I did it. Let me clear this. So what I did was to simply click on this, and I'm going to cut it, not copy it, cut, and then place it right there. Paste. All right. Don't worry about this. All right. Now, sitting here, I need to make permanent the variances and the covariances before I copy down. So to do so, F2. So click here for the variance of Argentina. To make it permanent, hit the function key F4 on your keyboard. So I hit F4, it places these dollar signs around it. It's going to make it permanent. So as I copy down, they're not going to change. Click here for the variance of Brazil, F4, function key F4, right here for the US, F4, and then the covariances. Click here for the covariance of Argentina and Brazil, F4. Click here for Brazil, for Argentina and the US, that's F4, and finally for Brazil and the US, F4. So now all the cells that need to be permanent have been made permanent, and I can go ahead and copy. Click there and go all the way down to the end of the column right there. So now, as you can see, all I have to do is simply hit equal SQRT, open parenthesis, and click on this guy right here to get me the standard deviation, which I can copy down already. It it's reflecting because I didn't clear all the entire cells which I had before. So that sets the order for the standard deviation. And for the mean of the portfolio, you do the same thing. It's much simpler. It simply is the weighted average of the means of the individual securities. So that will be equal, open parenthesis, W1 would be the weight for Argentina multiplied by the mean for Argentina. I scroll up, and that's going to be the monthly mean right here of 1.572%. And I'm going to scroll down so you can see my work right there. Close parenthesis plus open parenthesis. So now I'm going to get the second one. For that, I need W2, which is this right here, and I multiply that by the mean for Brazil. Scroll up just a little bit and catch it right there. All right. And looking at my work, I close parenthesis plus open parenthesis. Finally, I get the weight for the US, and to that I multiply the mean for the US, and that's it right here. Scrolling down, I've completed the game. Close parenthesis and hit enter. And that's how this is obtained. Now, so I'm going to cut this and I place it down here. All right, you cut and then you place it down there. Right? And afterward, hit F2. Make the means permanent. Click on the mean for Argentina. Hit F4. Click on the mean for Brazil. F4. Click on the mean for the US. F4. And then enter. Since you've already put in all the weights beforehand, you simply click and then you drag it down to copy down. That's it. All right. So that's precisely what I had before. So that's how this is done. Now I highlighted these two columns just to delineate the fact that these are going to be the two rows of data that I'm going to need to construct my efficient frontier. To do so, simply highlight these two columns, go to data, go to insert instead. Now choose the scatter right here and then choose the first scatter option right there, and you see it. That's it. A couple of things. First of all, again, the weights that you use, this is your choice. Second of all, do not worry if when you construct your efficient frontier, if it doesn't look this smooth and nice, which is actually the traditional form of the efficient set. Don't worry about that. The reason it actually looks the way it does is because I incremented my weights at the same rate from one to the next, from one to the next. That's the trick to it. But you don't have to do that. Secondly, please do not use my own weights. You need to be creative. Now, regardless of how your efficient frontier comes out, it's okay. It doesn't have to look this good. I use the line option here, but you don't have to use the line option. It's actually better to use the scatter option. So it shows us points. And yours could look in any old way. That's fine. The concept is well established regardless of how the efficient frontier looks. Down here, it says, notice that the optimal portfolios are those that lie on the efficient frontier, which is the upper part of the feasible set. In other words, these are the efficient portfolios from this point down here. This guy right here is called the minimum variance portfolio. Keep in mind, all of these portfolios consist of the same three assets: the Brazilian stock index, the Argentinian stock index, and the US stock index. However, they will offer you different rates of return and different variances, and the reason being the differences in the portfolio weights. So the question now is, which portfolio weights would fetch you the most optimal portfolios? And that's going to be the weights that give you the outcomes that you see on the frontier, from here down to the minimum variance portfolio. Any investor choosing these portfolios down here is irrational, actually, because these choices are not considered optimal, since for any choice made here, there's going to be a portfolio, a combination up here, which for the same risk, remember standard deviation is on the x-axis, which for the same risk, the ones here would offer you the higher return than the ones below. Therefore, the efficient frontier is from here to here, with this being the minimum variance portfolio. To find the minimum variance portfolio, simply sit here and use the main function, equal main function, open parenthesis, and then go up here to either your variance or your standard deviation column. Highlight all of the cells and then close parenthesis. If I scroll down so you can see my work, hit enter. And that's it. That's how you identify the minimum variance portfolio. So it's going to be the portfolio which if I go up here, it's going to be this portfolio which offers you a standard deviation of 6.7% with a mean return of about 1.03%. And this is telling you that to attain this minimum variance outcome, do not invest anything in the Argentinian stock market. Invest 70% of your money in Brazil and the remaining 30% in the US stock index. So that's about it. Now, the application here using the security market line is to show how the required rate of return is calculated, which you are now familiar with. To implement the security market line, we need three important parameters. We need the risk-free rate, and here it's given to be 3%, so you can use the same rate or any other proxy that you like. And the second is the expected return on the market, and here I'm going to use 9.5%. And finally, and most importantly, the beta of the stock, which here the stock in question is Apple. So I'm just going to use Apple to perform the stock analysis, and right up here I have the data set. I went to Yahoo Finance, collected the stock prices, and then using the same logarithmic form, I calculated, as you can see up there, the monthly rates of return in this column. So for me to obtain beta, I'm going to regress the return on Apple on the US stock market, since the S&P 500 is going to be my proxy for the market portfolio. To do so, I go to Data Analysis, and this time I'm looking for regression. So scroll down and click on regression. OK. For the input Y range, it's going to be Apple, because Apple is the dependent variable. A stock depends on the market for its performance, is the argument of the CAPM right there. And then click here for the X range. X is the independent variable, and that's going to be the market portfolio. So I go up here and I start from here for the market portfolio, and I highlight all the data points. Check labels in the first row, click here for output, and then quickly click here. While cursor's blinking there, let's go to the body of the spreadsheet and find a suitable place, like right here, and then OK. It says the X range and the Y range must have the same number of rows. So I did mess up somewhere. So as you can see, this ends at 151 and this is 152. So let's go back up here and fix it. So I'm going to clear that, and I'm going to start from the word Apple and work my way down, and then click here. And I'm going to start from here, even though the columns kind of shifted, but I'm going to stay there. It should come out to be the same. And I clicked OK, and that's the output right there. That's the output. Now this is the finished product already, which I formatted real nicely for you. The most important outcome we want to see here is the coefficient for the market portfolio, which is our beta estimate of 1.63. And that's what you see here, and that's what I use to calculate this required rate of return. So right here it's equal. You're going to click on the risk-free interest rate of 3% plus open parenthesis. We're going to get RM of 9.5 minus the risk-free rate, close parenthesis, and multiply this by beta, and that is your required rate of return on this portfolio. given its beta, if I may format this nicely, given its beta of 1.63. And this is a wrap. And again, this is Pat Obi, Professor of Finance at Purdue University, Calumet.